Let's bring in Adam Parker now and talk to him, of course, founder of Trivariate Research. Adam, great to have you here.
Yeah, good to see everyone.
Why don't we start on that dollar point? 10% down year to date, quite orderly. There's some benefits of that. There's some costs of it.
Right.
If it's another 10% in the second half of the year, does that scream something's wrong? Is something already suggesting that something's wrong or not?
You know, it's funny. I listened to your macro conversation up front, and then I looked at your screen and it said record highs for S&P and NASDAQ. So when you talk to institutional investors all day, they're not really day-to-day concerned with it. I think it's the most consensus macro trade out there that the dollar will keep weakening. I think everybody believes that.
That means it won't.
And, you know, that's the part that worries me a little bit is now, you know, everyone believes it. I think there's offsets, as you point out. I mean, you know, David just mentioned, look, if you get a commensurate loss in unit demand, that's bad. But all else equal, of course, a weakening dollar helps U.S. multinationals' earnings, all else equal. So the question is, like, do they change their patterns in spending or not? If they don't, you know, select industrials, pharma, tech, staples have a bit of an earnings, you know, tailwind in the second half of the year into next year that you'll start hearing companies talk about a little bit. So to me, equities are about margins expanding, and anything that makes me think on the margin they can go up, it makes me more optimistic, and that's certainly coming up. But the weakening dollar is the most consensus macro trade on earth. What is your number one sector pick for second half of the year? You know, there's two sectors I like, financials and healthcare. I think financials might be consensus, to be honest with you. I'm finding for the first time, you mentioned UK working for the first time in more than a decade versus the US. Well, I feel like it's the first time
only just as
ever.
Well.
Yeah, only just. But it's the first time I can remember, maybe since before the financial crisis, where I can find both like offense and defense in financials. Like I feel like you've got your defensive names, you can own Progressive and they'll keep working, or you know, select insurers. Then you can own offense. You can own the alts. You can own Jefferies. You can own things that could whip around and bounce higher if we get more M&A, and then you can own your kind of quality, you know, JPMs and Morgan Stanley and Goldman Sachs. So like, I just feel like there's lots of things to own in that sector, whereas in the past it was more of a call option on the rate environment or, you know, something else happening. So I like financials. And then I like healthcare. It's been a bit of a, you know, dog's breakfast, I guess you guys say across the pond. But, you know, it really
not that often.
Yeah, once in a while. But I like my dog, so my dog eats well. But, you know, just, you know, I think there's the productivity potential from AI implementation is super high. You have a lot of inefficient businesses, a lot of employees, a lot of low margin, and we've seen stocks when they have low margins and you dream they're going higher, trade at really huge multiples in other sectors. So that's part of the reason
I was wondering if the AI improvements, efficiencies, are helping to offset any margin pressure or profit pressures from the tariffs, because you do wonder who's paying all of this and where it's coming from if we're not seeing a spike in consumer inflation.
The reason you can't get too bearish on U.S. equities is because all the investments have a 2 to 3 year kind of return time. May 2023 was the first time NVIDIA had their big upward sales revision, right? So if these take 2 to 3 years, let's say 3 years, you're going to start seeing massive benefits in 2026. And so you want to get negative on U.S. equities, you know, do that while you have this dream of margin expansion. And I think that dream is still, you know, innocent until proven guilty, right? So I don't think you want to get too negative. And healthcare is probably the area where you can, you know, most quickly benefit. You've seen stocks in like drug distribution, McKesson, Cardinal, Cencora, which are really low margin businesses, be pretty good stocks because people are dreaming margins can go from 1 to 1.5 or something.
Or is it based in some sort of reality? And what's going to be the first tell that, in fact, these efficiencies that we've discussed are actually coming to the fore?
So we read in every word from every earnings call transcript with natural language processing. We look for any signs of it. Cencora, which is the old AmerisourceBergen, for those who have, it mentioned two quarters ago on their call, they made a comment about AI efficiencies. Walmart showed a little bit, maybe 3-4 quarters ago. So you're just looking for any verbiage around, hey, you know what? We can grow without hiring at the rate we used to. Or I can start dreaming I grow 3% per year without any net hiring at all. Quest Diagnostics, there's companies that are talking about that. I mean, you know what it's like. I don't know what it's like in the UK, but when you go to a hospital or a doctor in New York, half of them still hand you a clipboard and you're circling stuff and you're just like, come on, guys, like scan my retina, know my life, and let's move on, right? So there's just so much potential for improvement. So it's the classic, you know, is bad or is bad like good because it's opportunity for improvement? And I'm starting to lean more in the opportunity for improvement camp, just in terms of tech and healthcare, you know, driving efficiency. So I like both those, and they're not correlated, which is another thing that's good. Everyone I'm talking to is just looking for non-AI trades to balance the portfolio because everyone's just loaded in the AI trade.
Adam, as always, a pleasure.
Yeah,
Thanks
nice
so much.
to see everyone. All right,
Good to
happy
see you.
4th.
Yeah.